Welcome to Talk Tickers, your deep dive into the financial structures and technical shifts reshaping the global marketplace. Today we're looking at a change that, on the surface, sounds pretty minor, shaving just one day off a calendar, but it's a change that has sent, well, a shockwave through the operational plumbing of international finance. We're talking about the transition from T+2 to T+1 settlement. Our mission is to really unpack this for you. We want to reveal why this speed up, which was meant to reduce risk, has actually created some profound cross-border, technological, and liquidity headaches for investors all over the world.
Yeah, that's right. And maybe we should start with the basics. Settlement is just that final moment.
The moment the trade is actually complete.
Exactly. The buyer gets the security, the seller gets the cash. The industry calls it delivery versus payment, or DVP.
And that DVP process, it just got a lot more aggressive in North America.
It really did. So to define it, T+1 means settlement has to happen one business day after the trade date, or T. The United States basically dropped the hammer on this, making it effective May 28, 2024, for a huge range of products. We're talking cash equities, corporate debt, all of it.
And it wasn't just the U.S. acting alone, right? There was coordination.
Yeah, that's a key point. Canada actually moved a day earlier on May 27. And while, U.S. treasuries were already settling at T+1, bringing everything else into that timeline, it just fundamentally shifts the operational risk.
Especially for anyone outside the U.S.
Oh, absolutely. The time zone differences are now a massive factor. The clock is just ticking so much faster.
And this idea of speed, it's not new. I mean, finance has always been a race to be faster.
True. If you go back, say, 200 years, T+14 was standard. T+14. Can you imagine?
That's incredible. So this has been a long march. T+5, then T+3.
Right. And then T+2 became the sort of harmonized standard. The EU adopted it in 2014. The US followed in 2017. It felt stable for a while.
But the global momentum for T+1 just became unstoppable.
It really did. I mean, look at India. They went full T+1 way back in January 2023. And by October of 2024, you had capital markets that represent, 60% of global market cap, all settling on T+1. This is a huge global movement.
So the goal from the regulator's perspective is pretty clear then.
Yeah, it's about risk. The faster you settle, the less time there is for your counterparty to default. It's meant to create stability, efficiency, more liquidity.
But this global race has created these misalignments.
Massive ones. Just look at Europe. They've been on T+2 since 2015. Their regulator, ESMA, looked at what the U.S. was doing and basically said, we have to move too. The instability is just too great to ignore.
So they put a date on it.
They did. The recommendation is for the EU to move to T+1 no later than October 11, 2027. They're being pulled along.
Okay, so let's get into that friction, because the scale of what we're talking about is, well, it's mind-boggling.
It is. Foreign holdings of U.S. securities were, $24.9 trillion in 2022.
$25 trillion.
And equities alone made up over $12 trillion of that. So when a huge fund in, say, Frankfurt or Tokyo buys a U.S. stock, they are now facing a monumental challenge.
And this brings us to the core problem, what you call the FX funding conundrum.
That's it. And the problem isn't that T+1 is new for currency markets. FX spot trades have often settled T+1.
Right.
The issue is the knock-on effect. Because the security has to settle at T+1, it means the FX trade to get the cash for it has to happen much, much earlier.
Okay, so walk me through this. I'm a fund in Europe. I buy $100 million of some U.S. stock today. That's T.
Right.
The stock settles tomorrow, T+1. So I need my U.S. dollars ready to go tomorrow.
Exactly. Which means you, as that fund manager, have to execute your euro to dollar trade today on T.
Right.
And you don't just execute it, you have to make sure that cash, the actual U.S. dollars, is settled and ready for the securities transaction by tomorrow morning.
So the overnight window to arrange all that is just gone.
Yeah. It's gone. For many non-U.S. investors, it effectively forces them into same-day or T+0 FX settlement. That is a huge acceleration.
And this is where the time zones become a nightmare. I'm thinking particularly for investors in Asia.
It's a huge problem for them. I mean, imagine a fund in Singapore buys a U.S. security late in the New York day. They might need to get their U.S. dollars finalized before their own local markets have even opened the next day.
So they're trying to get their cash in order before the security trade is even fully confirmed.
Potentially, yes. It completely eliminates that overnight window they used to rely on to fix any errors or mismatches.
Which brings us to the regulatory hammer that forced this, right? SEC Rule 15C62.
That's the one. That rule says all the matching, the allocation, confirmation, affirmation, it has to be done as soon as technologically possible, but absolutely no later than the end of the trade date, end of day on T.
That is a fundamental behavioral change. I mean, buy-side firms used to have all night to sort this out.
And now they have a few frantic hours before the U.S. market closes. You heard stories about banks setting up operational war rooms in the run-up to the May deadline, just scrambling to get everything affirmed on time.
And the market anticipates this pressure. People are already predicting where the stress points will be.
Oh, yeah. The expectation is that FX spot liquidity is going to shift. You could see higher volatility, wider spreads, especially in one particular time window.
Which is?
Between 4:00 p.m. and 5:00 p.m. Eastern Time.
So the last hour of the New York trading day, why then specifically?
Because that's the final crunch time. It's the last chance for everyone around the world to secure the U.S. dollars they need for tomorrow's settlement.
If you miss that window.
If you miss the cutoff times for the settlement systems, the trade fails. And a failed trade means penalties, it means more risk. So all that activity gets concentrated into that final hour. It's become the new center of gravity for global USD funding.
That's fascinating. It sounds like it forces everyone globally to organize their day around the New York close.
It absolutely forces prioritization and, crucially, automation. But if you want a perfect concrete example of how this misalignment costs real money, you have to look at ETFs.
Okay.
Specifically, something ESMA called the Thursday effect.
The Thursday effect? That sounds ominous. Break that down for us.
Okay, so think about a complex product like an ETF that's domiciled in the EU but hold U.S. stocks.
Right.
The ETF shares themselves might settle fast, say on T+1, which is now common. But the underlying basket of U.S. stocks that make up that ETF, because of different market rules, they might still be settling on the old T+2 cycle.
So there's a mismatch. The ETF settles, but the cash from the actual stocks inside it hasn't arrived yet.
You've got it. There's a one-day funding gap. And the authorized participant, the AP, who handles the creation and redemption of the ETF, they're stuck in the middle.
They have to cover that gap themselves.
They do. They're forced to post collateral, their own capital, to bridge that timing difference. And it's not cheap.
How much are we talking?
Well, they often have to post collateral of about 105 to 110% of the transaction value. The estimates are that this specific misalignment could cost EU domiciled ETFs tens of millions of euros every single month.
Wow. Just from that one-day gap?
Just from that one-day gap.
Yeah.
It's a perfect example of a domestic rule change creating a very expensive cross-border problem.
And this pressure cooker environment must be changing other areas too, like securities lending. That's always been a sort of slower part of the market.
It has to change. The shorter cycle creates a huge risk for lenders. If you've lent out a security and you suddenly need it back to sell it, you have to issue a recall.
And now you have less time to do it?
Far less time. To avoid a failure to deliver, which can lead to a really costly buy-in, the new best practice is that lenders have to issue those recalls by 11:59 p.m. Eastern on the trade date itself, on T.
So another midnight deadline.
Another one. It's forcing an incredible amount of automation on a part of the industry that was traditionally more manual.
When you add all this up, the SEC's end-of-day rule, the 4 p.m. FX squeeze, this midnight recall deadline, it all points to one thing for me: cost. This can't just be a simple software update.
No, absolutely not. We're talking about massive fundamental infrastructure upgrades across the entire financial ecosystem.
Yep.
Firms are having to rip out legacy architecture.
The old stuff.
Yeah, the old stuff designed for a world of overnight batch processing. The compliance data we saw was pretty stark. For a small buy-side firm, you're looking at a minimum cost of around $223,000.
Just to comply.
Just to comply. But for the big global custodians, the ones handling that 25 trillion foreign assets, the investment is over $36 million per firm.
$36 million to shave one day off settlement. Why is it so astronomically expensive?
Because you're dismantling systems built over decades. Systems that relied on sending files back and forth overnight. You have to replace all of that with real-time, event-driven API architecture.
So it's about instant communication.
It's about instant communication and automated reconciliation. If you don't have it, you are guaranteeing settlement failures. It's a mandatory defense mechanism now.
So with all that cost, what are the specific strategies the industry is using to, buy back some of that lost time and bridge that funding gap?
They're mobilizing solutions that offer immediate secured liquidity. A big one is establishing more short-term funding arrangements, like secured fund financing.
How does that work?
It's where a fund manager can actually pledge their existing portfolio holdings as collateral to get cash really quickly to meet those USD gaps.
Using assets they already own to get fast cash. Makes sense. What about the big players who hold lots of treasuries?
For them, a critical tool is something like sponsored member repo. It's a centrally cleared market where firms can very quickly raise US dollars by posting their treasuries as collateral. It's about turning a safe but illiquid asset into instant cash.
So it all comes back to automation. That seems to be the key word in all of this.
It's no longer optional. It's a cost of doing business. You need systems that automatically trigger an FX execution from a security settlement message. You need true, straight-through processing.
Is everyone ready for that?
That's the billion-dollar question, isn't it? The big firms, they mostly reported being on track. But the real concern is around the smaller third parties, the regional brokers, the niche tech providers.
The fear is that a link in the chain breaks.
Exactly. There's a very real fear of fail rates getting worse, at least initially, especially if smaller non-US firms just haven't been able to synchronize their operations with this new, very aggressive American standard.
We've covered the speed, the shockwaves, the cost, the operational crunch. It really leaves us with one final big question that you, our listeners, should really think about. The entire industry is spending hundreds of millions, maybe billions, just to survive this shift to T+1. And it makes you wonder if we're making a long-term investment in what might just be a short-term patch. So here's the one question. Given that T+1 is forcing same-day or T+0 FX execution for so many global investors, is this T+1 mandate just an expensive temporary stop on an inevitable global path to T+0 security settlement?
That is the provocative thought, isn't it? Because the cost and complexity of just bridging this one-day gap, all the new funding facilities, the automation, it might actually be greater than the cost of just making a coordinated global leap to real-time instantaneous settlement.
Why stop halfway?
Why stop halfway? It's a great question. So to recap for you, the U.S. shift to T+1 has definitely reduced some risks, but it has created this incredibly complex web of operational and FX risk for everyone else. It's mandating huge technology investment and really fundamental changes in behavior, especially around getting US dollars on time. So for you, the informed investor, if you want to track how this is all shaking out, you need to watch two things. First, keep an eye on the overall market fail rates. And second, watch the FX liquidity and volatility right around that critical 4:00 p.m. Eastern Time window.
That's the new flashpoint.
That is the new global flashpoint for US dollar funding.
And that's a wrap on our deep dive into the T+1 settlement. Thank you for tuning in to Talk Tickers. If you have a topic you want us to dig into, please let us know. Until next time, stay informed.